Cash flow from operations. Rashid Company reports net income of $480,000 for the year ended December 31st, 2011. It also reports $86,400 worth of depreciation expense and a $7,000 gain on the sale of machinery. Its comparative balance sheets reveal a $38,400 increase in accounts receivable, $19,680 increase in accounts payable, and $10,560 decrease in prepaid expenses, and a $14,880 decrease in wages payable. Required: prepare only the operating activities section of the statement of cash flows for 2011 using the indirect method. So the first thing we'll do is we'll start off with net income. Net income from operating activities would be $480,000, and then we'll make adjustments. So our first adjustment will be depreciation. And since depreciation of $86,400 was included to come up with this net income total, and depreciation is a non-cash item, then we want to add that back to this $480,000. Again, non-cash item, add it back to the net income to get the true cash flow from operations. Next, accounts receivable increase. Whenever accounts receivable increase, what happens is you're not collecting as many accounts receivable. And when you don't collect as many accounts receivable, you have to assume that that's tying up your cash. Therefore, that would reduce your cash by, in this case, $38,400. So if accounts receivable go up, that means you're not collecting as many receivables, and they're being cash is being tied up in receivables. So therefore, you want to subtract that out to get the true cash flow from operations. The next thing will be prepaid expenses. If prepaid expenses decrease, that means you're not buying as many prepaid expense items with cash. Therefore, when they decrease, that means that cash from operations went up. In this case, they went up $10,560. Next, we have accounts payable increase. Accounts payable, in this case, increased during this accounting period from one period to the next. And if accounts payable increase, that means you're not paying off as many accounts payable as you incurred. Therefore, that increase in accounts payable means you're using less cash. Therefore, cash, in this case, if it was a change of $19,680, you would add that to your cash flow from operations. Next, wages payable decrease. In this case, you are paying off more wages than you incurred, and in that case you're using cash. Therefore, cash is going to be reduced by, in this case, the difference between the one period and the next, which was a reduction of $14,880. And now the last one, gain on sale of machinery. Well, whenever you buy machinery or sell machinery, that's not an operating activity. That is an investing activity. And if you sold a piece of equipment and got a gain on it, all of that gain should show up in the other section of the cash flow statement, which would be the investing activity. Therefore, on the income statement, it's being subtracted to come up with this total. And what you want to do it's being added to come up with this total. So what you want to do is you want to subtract it, because all of this gain should and will show up in the investing part of this cash flow statement. So you take the beginning net income and you make these changes to it, and you'll come up with a net cash flow total adjustments of $56,360, which you will add, because it's a net plus, to the original net income figure to come up with net cash provided from operating activities of a total of $536,360.